What a wild week with the Jerome Powell rug pull on Wednesday and already a strong rally to close out Friday. But is the rally just setting up a daily lower high opportunity for more pain into the holidays? Or should we expect what we got in August, a V-shaped recovery straight back into all-time highs? That's what we'll look to answer in today's episode of the Trade Brigade Weekend Show, where of course we'll evaluate all of the data points. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, there's definitely a change in tone here. We haven't seen a bar like this in a very long time. It's a larger red-bodied bar, of course, but let's not ignore the lower wick. The lower wick would imply that buyers stepped up off the lows of the weekly range and they were able to close slightly higher. Definitely not in the midpoint of the weekly range and definitely not towards the upper third of the weekly range, but there was some sort of buy-side response off the lows, which is important. If we're thinking about location on the bar-to-bar count, we absolutely have a lower high as well as a big-time lower low, and a close completely outside of 3 weeks worth of range. I would say that on the bar-to-bar count individually, the bears are in control here. However, it's about where the bearish narrative stops. If we're considering the overall context of the weekly time frame chart, we have lows, we have higher lows. These are soft higher lows, these are firm higher lows. This is a soft higher low over here. And recall that a soft higher low just simply means that the daily trend never flipped to down during that red bar. The daily trend is in the process of changing to down. We can certainly acknowledge that here. So is it reasonable that the retest of this area here could provide a firm higher low on the weekly time frame chart this go around? I think the answer is absolutely yes, right? And that would preserve the weekly uptrend. We are ultimately pulling back from the highest high in the trend count. That's the all-time high. And this is a reasonable place for buyers to step up. Previous resistance acted as support once. It's trying to act as support again. Hence the emphasis on the longer lower wick we were just talking about when it came to structure. Now, if we consider what happened during the August 5th panic, let's scroll back over here. We can make some general comparisons, right? So this is the August 5th gap down right here. That was a Monday to start the week. Now, prior to that move, the weekly trend was what? Up, right? We had lows, we have higher lows, soft higher lows. These maybe were soft higher lows, but I would consider that the main low attempt, right? That's really just an inside bar on the weekly up here, right? So we're pulling back from the highest high at that point in time. We had been pulling back, and here's the August 5th gap down. So on a relative basis, it's probably fair to say that this previous resistance is similar to this previous resistance. This soft higher low is similar to this soft higher low. We opened underneath the weekly pivot, but we closed above the weekly pivot. We tested under the weekly pivot, but we closed above the weekly pivot. Is it reasonable that this holds as a higher low and we look for that V-shaped recovery back to the highs? I think the answer is yes on the weekly time frame chart. I'm really not concerned about a weekly trend reversal. And if we zoom in here, we can actually build more confidence based on confluence with some added indications, right? Let's come in here with the Fibonacci's from the August 5th gap down to the recent all-time high. All of this is taking place over the Fibonacci 38.2. That's bullish. If we come in from here, the low of the election bar up to the all-time high, you can see that if we do this, right, we talked about this last Saturday, previous resistance acted as support. It's also the 61.8 Fibonacci, which is always the line in the sand Fibonacci. The fact that buyers stepped up here makes a lot of logical sense based on fibs, based on candle structure, but wait, there's more. If we go ahead and throw in the anchored VWAPs on the weekly as well, I'll certainly concede the point that we're absolutely underneath. We closed underneath the election anchored VWAP. We're closed right at this prior all-time high anchored VWAP. But look at this one. This is the breakout, which really resumed the weekly trend to up after that August 5th gap down, right? So we made the equal high here, we pulled back for a higher low, and then this breakout bar really set the tone, in my opinion, for the next leg to the upside happening here. That did hold as support, and once again, it was confluence with that 61.8, with 585 roughly as a zone here. So on the weekly chart, as long as we're over 585, I would not at all have a concern about the weekly trend trying to change. If we see this upcoming shortened holiday week that we trade into the equal low, that's where I would start to suggest that the weekly trend has the opportunity to neutralize, but I would not be an outright bear if we're just getting a test of this prior low back here. I would be neutral on the weekly trend, but not bearish. And I think there's a big difference between those two things, right? Of course, the threat then becomes if we move here and then we set some sort of lower high, call it a weekly head and shoulders. Let's not get like too far into the future here, one step at a time. In my opinion, this absolutely, based on the reaction of what happened last week, certainly could offer a weekly higher low. If we come in here with our volume profile, just to be completely exhaustive of everything that we typically look at, where are we holding up? Where are we holding up if I zoom in on this, right? Doing something like that, we can all see it is a high volume node. As long as we are over this high volume node, that means that these folks are not yet overhead supply, and the bullish thesis probably lives on. So the weekly chart to me is just offering the opportunity of a higher low to continue the trend in the upward direction after pulling back from the highest high in the trend count. Check for the bulls, looking for that V-shaped recovery back to all-time highs, basically. Let's drop it down to the daily time frame chart now and start to get a little bit more granular. The first thing we'll evaluate here is the weekly expected move, which is this gray shaded area. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the numbers at 601.15, which unfortunately for the buyers is suggesting a lower high. If we're contained by the lower bound, the numbers at 581.19, basically an equal low to that Friday morning gap down. That's really not that bearish. It's an equal low, but it's not a lower low. So on the daily time frame, the trend is no longer in the upward direction, and I would concede that this again is somewhat of a threat, especially noting that that would suggest a lower high underneath this balance range up here. We just mentioned on the weekly time frame chart that, of course, we're looking for the weekly higher low, but the reason it's a firm higher low is because the daily trend is starting to flip to down, right? Remember that we did have an hourly downtrend here, which means that this would have been the next daily higher low. So this absolutely is a lower low. If you don't subscribe to this whole soft higher low, firm higher low thesis like we do here at the Trade Brigade, that's fine. You could even just say this, right? From here to here, undoubtedly, you still have a lower low. So it doesn't matter how you slice the cake here, the daily trend is in the process of changing to down. Now, the trouble with trying to get involved in daily downtrends is that unless there's a big substantial shift in the market, it's really not going to play out that well. So a couple of comparisons that I want to make here relative to the August 5th gap down over here. So first and foremost, we are coming from an uptrend when we gapped down on Friday, which felt like an exhaustion gap down, right? What were we coming from during the August 5th move? This was already a daily downtrend, right? We had highs, lower highs, lower highs. We had lows, lower lows, lower lows, massive lower low on the gap down. So the strength of the trend back here was actually much weaker than what we're dealing with currently. Notice that the trend was down, and even prior to the major exhaustion gap down, we were well underneath the daily 50 SMA, which is the blue moving average on your screen. As of Friday's close, we're right at the daily 50 SMA. Yes, we gapped down underneath it. Yes, we closed underneath on Wednesday with Jerome Powell and his press conference. But relative to the distance underneath, we're hardly unchanged from the 50 SMA on the daily, right? So not that the 50 has like some sort of magical power, but just relative to the strength of the trend, we're in a much stronger bullish trend over here than we were back over here. So is it logical to think that the weekly chart could offer that higher low, and we don't really want to lean into the opportunity of a daily downtrend all that aggressively until it's firmly down? I think that's the logical approach to take here. So how does the daily trend firmly flip to down, and how do we avoid getting caught on the wrong side of that? Well, certainly would require a lower high, which again, we'll acknowledge that the upper bound of the weekly expected move could suggest that. If we see a move here that rejects firmly underneath 603 and starts to roll over, you're starting to build out what, right? Left, head, right shoulder. So where does a daily, or any really, head and shoulders pattern start to trigger the aggressive breakdown? Hopefully everybody's saying, right, this is the textbook answer, underneath the neckline. So not real, like the point being here is that I would not want to be short on the lower high shoulder here, looking for that right shoulder, because we know that the daily downtrend might be very short-lived here if this is truly going to hold up as a weekly higher low. Remember, this is the competition of the time frames. It's like the two charts are butting heads with one another. So generally, history tells us that daily downtrends are short-lived, right? We know that. Pullbacks get bought. Markets were designed to trend in the upward direction. We want to learn from our mistakes from back over here. If you recall, and you can go back and you can look at the video titles, right? I was still bearish, looking for a potential lower high underneath the 50 SMA, rallying off of this low back in August. Now, I'm not going to consider this even the same opportunity on the daily time frame chart because we're already at the 50 SMA. If we rally to here, right? Maybe there's a little bit of a pullback, but what would be the better opportunity walking forward out of this chart, right? As I zoom in here, we can start to get a little bit closer to the more recent price action, right? The opportunity, in my opinion, would be that, okay, we rally to get here. That means that all the shorts who participated in the sort of late stage of the breakdown from FOMC and even Thursday, those shorts are underwater. If we pull back and set some sort of higher low, I would just be bulls on parade, flipping the daily trend back to up, aligning with the weekly trend, looking for all-time highs again. And guess what? Maybe that's the Christmas present that the market's going to offer us. It's a possibility here. So generally speaking, as I organize my thoughts on the daily time frame chart, I would be expecting the continuation of a counter trend rally, looking for a test of 603. If we get here and we pull back, the idea is that we hold up for any higher low over this level right here. This would be the absolute line in the sand for the higher low, 590.75, right? It's the opening print of Thursday, it's the 50 SMA, it's the closing print of Friday. You have to hold up over that if the buyers are going to set that higher low and instantly change the trend back to up, in which case I would look to exceed this high over time, and this might take a couple of weeks to play out, right? But over time, exceed that high and make the move to the all-time high. If this does not hold here, that's where I will absolutely bring out the red crayon and say, hey, that election gap, it's looking pretty darn juicy. Underneath 583.85, which would start to invalidate the weekly higher low thesis, right? Starts to bring in the gap close. And what's the target on that? 576.75. Beyond that, we'll walk it down here. That's going to be at 569.85, where we start to get the weekly equal low that we were just describing that neutralizes the weekly trend, right? So the bears, they want to see this head and shoulders play out, but I would not jump the gun on this pattern knowing everything we just talked about relative to what happened in the August 5th situation, right? Another thing that I want to draw on from the August 5th situation, and by the way, obviously, if there is no counter trend to set up the 603 lower high, and if we just get consolidation down here, you're still just using this as your susceptible area to cause a potential breakdown, right? Back into the election gap underneath 583.85, that's where things start to get a little interesting. Probably, yeah, focus on the equal lows, apologies. So this definitely represents the remainder of the election gap, and technically it's this after Friday's gap down. But the two equal lows from Wednesday, Thursday, probably are an important level, and we'll get to that on the hourly. That's 585.85, right? Okay, so let's go back to the August 5th example, though, because I do think there's a lot to learn from over here. One of the things that you'll notice that took place as this rally extended itself basically back into the all-time high is that we were one time framing. This market was one time frame, meaning that every single daily bar offered a higher low. This is equal low happening here, but higher low, higher low, higher low, higher low, higher low, higher low, higher low. It was not until we finally had a lower low that the market actually balanced off and was like, okay, we'll chill out here as we've come back into the all-time high. I'm not saying that you need a one time framing market to the upside, but if you notice that that's what's going on, just please, no reason to short the market, right? If you're noticing one time framing in the upward direction, I would not try to be a hero and call like, okay, it's the time right now for a big time lower high. Markets are going to crumble and crash. If the market's one time framing, that is incredibly bullish. What it's telling you is that anybody who's shorting the market is getting left in the dust. There's no opportunity for those shorts to cover, and it will continue to propel the market in the upward direction, right? So that's an idea here as well to lean into based on our previous experience from over here. Let's get back on over to the recent price action, and let's actually just take this thing down to, now before we go to the hourly, let's take a look at the Fibonacci's from the all-time high to the lowest low of this move. Where did we land relative to this? We did technically reject the 50% retracement. That's not really the most bullish thing. We did close underneath the 38.2, so the bears who really want me to lean into the bearish narrative here you go. Technically, anything that consolidates underneath 590.75 offers just a daily bear flag, right? There's your flagpole, here's your flag consolidation. Anything that remains below, probably looking for that election gap to close. So I will give you that on the daily time frame bears. You did manage a close underneath the Fibonacci 38.2, persisting, or I should say, preserving the bear flag consolidation. So under the 50 SMA, under the 38.2, underneath the top of this prior range, 590.75 is your key daily level. If you want to remain bearish, you're looking for action down here like this. If you want to get bullish, right, it's this, higher low, send it back to the all-time high. Let's drop it down to the hourly time frame chart now because this is where things get fun. As we take a look over here, a couple of things to point out. Obviously, on the gap down open from the Friday session, sellers did not do their job, right? If you're a stronger seller, what do you want to see? You want to see a rejection of the prior day's low for a classic textbook gap fill reversal, then continuation of the move in the downward direction. Didn't happen. Beyond that, we actually broke out over the Thursday high. So this is almost an outside reversal bar back in the upward direction. It takes a lot of buy-side strength to make that happen. The next thing to point out is that the pullback was very mild into the afternoon session. It's not like we had just a big, I'll concede that a lot of this is probably short covering, right? But we didn't really have aggressive sellers step back up into the market and say, hey, we're going to short this again at higher prices and just drive prices instantly back down to the low of day. As a matter of fact, it looks pretty constructive over that 590.75. So on the hourly time frame chart, the pathing that I'm really most concerned with early in this upcoming week, which keep in mind is a shortened holiday week, this is interesting for a Brigade bolt here to retest your 603. That's where the buyers really start to get involved. Over 595.25, I think that the move continues in the upward direction. 603 is a thin structure retracement from back over here. If you're persisting in this range, there's not much to say. I would not want to get involved in that sort of consolidation, but it's absolutely not bearish. If you're over, let me be clear about that, right? If you're over 590.75, if you're not seeing attempts to get back down towards these lows, shorts are offsides. So consolidation in here, I probably don't want to participate, but it's not bearish. If we move under this level, that's where I think you have the bears back on parade, probably trying to exploit risk reward along these lines, and then of course the gap closed to the downside. So I think that the overwhelming amount of data probably supports more of the counter trend move continuing up towards this 603 level up here for then a large test, and basically the next determining step of the market will be made there at 603. But that's kind of what I'm seeing, right? This is the early stages of this upcoming week. Obviously, markets are closed on Wednesday for Christmas. They'll close early on Tuesday afternoon at 1 p.m. Eastern time. So it's going to be a really quiet week in terms of the amount of participants out there. However, let me just remind you that oftentimes with lower liquidity comes higher volatility. Okay, and we'll talk about volatility here in just a moment. But before we get there, let's quickly throw on the intraday anchored view apps. Intraday anchored view apps tell us what? They support the idea. This is the Jerome Powell anchored view app right here, this one, which is pretty much spot on the money at 590.75. That's Jerome Powell's speech, or sorry, the interest rate decision. Speech is a little bit later, but that's his anchored view app. As long as we're above that, again, it's bullish for all the reasons I've just described. Shorts are trapped down here. As long as you're over 590.75, great confluence with that view app. As these start to barrel down early in the week, right? As the week persists, these will do something like this. That just reinforces the idea that you'll learn something over 595.25. If you can get this Brigade bolt above, I think 603 happens sooner rather than later. And once again, lower liquidity means higher volatility. This, I mean, even though everybody's preparing for a quiet week, this could easily become a reality in the next, what is it, like 3.5 trading days that we have as the holidays unwind, right? So that's what I'm watching for here. I think it all makes very logical sense on the S&P charts based on the price action, based on where we can see participants are trapped down here. Let me just point out also the equal lows from what we had on the end of the Wednesday session and then Thursday's close as well. That is 585.85. So if you're looking for a short, I would start to really get on that side of the market as an if we're underneath those two equal lows. I would not wait for the low of the gap down open from Friday here, right? I would start changing my tone under 580. Well, I'd really start changing my tone up here, 590.75, then more aggressively underneath 585.85, looking for that breakdown to close the remainder of the election gap. We talked about these levels already, 576.75. All right, there's your hourly analysis. That's the pathing. Those are the levels that I would really focus most on. I do want to move into the internals and also make a comparison here because this is going to help us determine what we should do this week relative to whether or not V-shaped recovery or continuation and crash to the downside, right? So first of all, if you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. The first thing we should focus on is the volume flows. Obviously, huge outflows from the market on Wednesday, Jerome Powell's rug pull, but look at the inflows on the Friday session during this big move to the downside. Now, this is really, really impressive because what does this measure from? This measures from the previous day's close. So across the exchange, everything, basically everything, and you can see this over here in the advanced decline line as well. This measures the same, right? This measures from the prior day's close. Everything across the NYSE exchange had basically recaptured the prior day's close, and the amount of volume that was flowing into up stocks versus down stocks was huge. Let me just clean up remove here for a second the cumulative volume, and let me show you the difference between the outflows on Wednesday. This is the ratio of volume flowing into, or I should say, out of stocks versus into up stocks, right? You get the idea. This is bearish volume flows as a ratio. This is bullish volume flows. This is the historical plot of these numbers right here. Okay. What I'm trying to get at is that the Wednesday outflows were not nearly as aggressive as the volume inflows throughout the session on Friday. There was much more of a clear demand, like, hey, gimme, 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 gimme. I want to buy everything in the market. Much more of a demand for shares here on Friday versus, hey, let's unload everything on Wednesday afternoon based on Jerome Powell. This, to me, absolutely indicative of new money buyers stepping into the market. Here as well, advanced decline line gets in trend higher zone. The index score is strong all day. All day. Jerome Powell's day, just into the afternoon, right? Which makes sense because he was the catalyst for the entire move, but all day. It's not like this was just whimpering out and just sort of flat near the zero line on the counter trend. If that was the case, then I would not be sitting here talking to you about, hey, I think the weekly, higher low is going to hold. Hey, I think we should look for the daily trend. Yes, it's technically going to give the opportunity for a downtrend, but we don't want to trust that too much. I would not be talking about these things that we just talked about over on the S&P hourly chart, daily chart, if the internals were poised differently. The index score strength here is meaningful. This is meaningful. This volume flow, absolutely meaningful. If you look at the cumulative build out of the tick, it's kind of a little bit lackluster relative to what we have in these other reads. So I will give the bears a little bit of credit there. Now, the only thing that we can do to complete the analysis is really compare this back to what happened over on August 5th. So I've got this little time frame mapped out already. Let's bring back the charts. So what do we notice here that's different? Well, first of all, the Monday gap down from August 5th was some of the largest bearish outflows in volume. Did we have that on Wednesday? No, we just saw that we were hardly at negative 10. This was sitting here at like negative 66 in terms of the ratio, in terms of bearish outflows on the Monday gap down August 5th. So not nearly as aggressive selling on Wednesday of this week versus August 5th's gap down. The follow-up sessions, it was kind of bullish up here, getting up and over the 300 million mark, even more bullish over here. So we had two follow-up sessions that were both bullish. Now, if you recall, we actually had stronger moves out of the S&P volume flows into the end of the week. Friday was stronger than this, was stronger than this. It was so much further above the 300 million mark. And if we take a look at the volume ratios down here, taking a look, we also just saw that on Friday, we had volume ratios that were up and over 10. So if this was enough to cause a V-shaped recovery back in August, do you think it's enough to cause a V-shaped recovery this time around? Based on everything that I'm seeing here, looking at this, I think so. The same thing happens with the index score, which of course measures from the open. Pretty solid read happening here, right? This is after the Monday where the pain really stepped in. So in my opinion, the internals, the data at the exchange level is not any different really than, it's actually more bullish than what we had on August 5th when we saw a V-shaped recovery straight back to the highs. And keep in mind, when August 5th unwound, let's just go back there on the daily time frame chart, we had an FOMC at play as well. I mean, it was not an August FOMC, but July 31st, that was your FOMC. That's right in here, right? FOMC, the follow-up day is big down, right? So you're still having similar catalysts. We had a Bank of Japan meeting, which they were unchanged on their decision. We had Japanese inflation come out hotter than the expectation, and the market did not pull back as aggressively. So a couple of things, just to bring this all back full circle, that we're seeing based on pure price action. And then I want to cover the VIX before we get to the NASDAQ. First things first, the weekly trend is still aggressively up. Second thing, the daily did not really break down as aggressively as over here and is in a much stronger position from a trend point of view. We've already closed back over or near a key inflection point, 590.75, the high of the previous day. Notice back over here, this previous day was much further away. So there was much more of an opportunity for a lower high to get set. I think we already have the opportunity for the counter trend to get the full lower high up against 603, as we've said. So there's a number of bullish divergences that I'm seeing here that are not even close to the August 5th move. Now, again, these are the data points that we have in hand. Does it mean that the S&P is going to do exactly what Matt says and look like this into the end of the year and go forward? I would love it if that's the case, and that's what the probabilities I'll be, those are the probabilities that I'll be personally trading around into the end of the year. But, if that doesn't start to unfold, if we get consolidation down here, I'm not afraid to change my tone if we start breaking down into the election gap, right? If we get into here and it looks like, okay, the market's remaining weak, I'm not going to be like blindly trying to long this back to the all-time high. Let me be very clear about that, right? But the probabilities, based on what we had in the August session and what we just experienced, in my opinion, probably favor much more of the attempt at a V-shaped recovery than anything else. As we look at one additional indication before moving over to the nasty NASDAQ, I do want to show you volatility. And volatility is interesting because it's a mean reverting instrument, right? This is the yen carry trade where everything blew up, right? We did not even get as panicked per se, which makes sense because we know the trend strength on the S&P is actually more bullish over here. But one of the things that you can look for when it comes to a capitulation style bottom is the VIX is going to make a spike and then it's going to stop moving to the upside even if the market's moving down. So conveniently, we actually saw an end of day pullback on Friday, right? That's this right here. Let's see what the VIX did as that pullback was taking place. So here is the market rally, of course. As this, let me see if I can, how can I align these? If I use my zoom tool, let me get these so they're perfect mirror images of one another or close enough, right? So this is down, they're inverse, right? But what happens as this pullback takes place, right? This in particular, the VIX continues to fade off. So instead of continuing to rally here and remaining completely inverse to the S&P 500, volatility is already subsiding. So is it over? Was that the capitulation bottom? The VIX also sort of agrees with this idea, right? That's one way to look at it. The next way to look at it is through the VVIX, which of course is the volatility of the volatility index. This broke out over what we would consider the heightened zone over 120 and is already back underneath in the very next handful of days. This took a number of days to unfold, but it was underneath and then things settled down. So this aligns with volatility subsiding. What else aligns with volatility subsiding? This one is like a kicker. This kind of is amazing to me. It's this right here. This is the forward month and back month, or front and back month of volatility contracts in terms of the VIX futures. And during the big plunge to the downside in the S&P, we did fall into a backwardation. All that means is that there's more risk in the present day than there is in the future, right? That's what that suggests when we're negative on this line. Where did we close the week? We closed the week over 0, right? So what does that mean? These flip-flopped. So instead of there being more risk in the present day, there's actually more risk in the unknown future at some point. And why is this reasonable, right? Because money managers like to allocate capital under these circumstances when there's less risk in the present day. It's like, okay, everything's fine and dandy. We can continue our normal process. When it's inverted, you're not going to see money flow into the market. Same thing happening here, 9 versus 30-day VIX, and the one-day VIX coming back down underneath 2145, right? As long as we're not above that level, decent move. Market's obviously been more comfortable in the midpoint here, closer to 1275. We did hit that as a low, or close to it, on Friday. Now, Matt, what did we have back during the August 5th move? August 5th, on the counter trend, this is the date that this was tweeted was August 11th, okay? So here's your timestamp right here. August 11th, many days after the August 5th gap down. We were still inverted on the backwardation in the volatility futures contracts. I was thinking, okay, there's this opportunity to remain inverted. You wouldn't use classic technical analysis here, but the point being was that we were under the 0 line. This was at the 0 line. This was still elevated and had not hit that 1275 yet on the one-day VIX. So I'm very thankful that I was able to record archive some sort of record of what was happening with volatility back then, because these futures expire, right? These are expired. You couldn't really go back and look at this if you tried now. So this screenshot is massively helpful. We're already back to contango. That's comfortable for market, capital allocation. We're already there. Another data point, in my opinion, that supports more of this rally to the upside. So everything that I can see based on the premise and the analysis that I conduct, I really think that this is more of an opportunity. This sends us back to all-time highs. If we're in here, again, I'll be open-minded to saying okay, obviously it's not happening. But everything from a data perspective, in my opinion, sides with this much more than this over here. All right, that's your S&P deep dive today. We've got to probably do a speed round through everything else if this video is not going to be 3 hours long or whatever. Let's go to the QQQ. Let's take it up to a weekly time frame chart. Let's see what we can see over here, and we'll keep this show moving along. QQQ, very similar. So candle structure, a little bit more of an upper wick on this one, less of a lower wick relative to the S&P. Nonetheless, still a solid red-bodied bar. Higher high and a lower low. So an outside bar here in terms of range on the weekly, still well above this inflection point where I would imagine that a weekly higher low can persist. So no issues out of the QQQ weekly trend. We'll leave it off at that on the Q's weekly. As we come back down to a daily chart for the NASDAQ, We'll take a look at what's happening here. So the weekly expected move is this box, 529.51 and 507.75. Lower high, very similar to the S&P 500, and kind of an equal low to the Friday gap down. In terms of the daily trend, it would have been best if the market could have held up over 514.85. I do like the close back above, and I would still actually, becomes tricky because this was the last higher low. We had an hourly downtrend here. This is a firm higher low. Obviously, we're underneath that. So a little conflicted internally. I'd like to give this the wiggle room, the leeway to say that 514.85 can still produce a higher low. Notice that we did not breach the 50 SMA. To me, this is a stronger looking chart. The trend here is strong as well, relative to as well. If we just look back to the August 5th move, already underneath the 50 SMA, big gap down, actually tested the 200 SMA. So a much stronger trend happening over here. Sharp pullback, absolutely, but is the trend destroyed? Not really. Not really. So key levels, if I was to be a daily like swing trader, if you were looking for just big inflection points out of the NASDAQ, I would say here and here. Here and here on the QQQ. Over 514.85 is bullish. Over 521.25 is even more bullish. This is the hourly head and shoulders, right? That's the neckline there. So this is where it's like rock and roll, thin structure retracement looking for 533.25. If we're in here, it's kind of that neutral territory, but once again, like the S&P 500, I would not be bearish here. That's actually keeping bears off sides. Anybody who shorted the gap down like a fool on the Friday open. If we're underneath 514.85, those bears rejoice, right? And they get a little Christmas gift looking for the downtrend to continue or develop underneath the daily 50 SMA. That would really be a breakdown underneath Friday's low at 510, the top of this little balance from back here as well. The bears really have to take it one step at a time. There's a lot of structure here off to our left that you need to be mindful of if you're looking for big shorts. As we take out the Fibonacci's on the NASDAQ from the top to the bottom, then we'll move to the hourly. What do we see here? 50% retracement, yes, closed under the 38.2. So once again, it just reinforces, it's actually beautiful that that's spot on the key level there at the 521.25. Underneath that, again, I would be neutral to still bullish here. It's going to require, in my opinion, a move underneath 514.85 to get me back in the bear camp. I would probably say that these odds are higher based on everything we've described so far today. Let's take this down to the hourly chart. Let's see what we can see over here. Rinse and repeat of the S&P 500 logic. Of course, this is why that's such a key level at 521.25. There's the neckline of your head and shoulders. If we're in here, it's neutral, not doing much. If we're back in this zone, looking for this probably as a thin structure retracement trade that's over 524.75. On a higher low, trades 533.25. If we start to get the breakdown under the 2-day low, remember, you're probably not waiting for this down here underneath 514.85, trades to 510. Then you can walk down your targets from there. Would you... Here's one thing to consider. Would I want to be a brand new money short right here at the equal low? Probably not. You've got your daily 50 SMA, lower edge of the weekly expected move. I think that the risk reward favors longs here, actually. I don't know that I would be bottom fishing because the daily chart's in the process of reversing, right? In terms of a daily downtrend, highs, maybe lower high, equal low sets that up. So I don't know that I would want to be short or long, really, at 510. That's kind of a tricky spot to be here with the daily 50 SMA as well. I think you would need a cleaner breakdown. And let's go to the weekly chart as well. I know I'm all over the place here with the NASDAQ, or I'll just zoom out on the daily. Let's not forget why this level is still on our charts, right? 503.25, previous all-time high. This is the weekly higher low thesis. So the competition of the time frames, in my opinion, really is not suggestive that right here, right now is a great time to initiate new money shorts. If you've got a really high time frame perspective, this risk reward on the long side probably makes more sense, right? So that's your QQQ. Let's take a look at the NASDAQ internals. Again, in the sake of saving some time here, what do we have? Strong volume inflows, trend higher zone, cumulative build that was positive. Once again, I think that the bullish nature of the inflows here, strong move happening up here, this probably, in my opinion, is more of the indication that aggressive buyers are trying to step back into the market, and this is not, a market that's ready to fall apart completely. Another thing to keep in mind is that markets crash from the lows, right? They don't crash from the highs. That's just a classic that we have not mentioned in a while. And I'm realizing now that we did not look at the market profile for the S&P or the NASDAQ. One of the things that I think just continues to add into this narrative here, this is the Russell. We want the ES first. Here we go. On the day where Jerome Powell spoke and the market broke down, look at where the point of control was. Why? If you're a stronger seller, and I get it, it's because the range was so expansive that there was no chance for volume to really collect and pool up at one specific spot. But this just means that, you either have a ton of trapped buyers up here, or just the sellers, as prices moved lower, really weren't all that strong. If you look at the value area and the point of control from the Friday session, it's right I would say that the point of control is right at the highs basically here, but the value area is overlapping to up on Thursday's range. What does that tell us? Again, stronger sellers not involved. If you had stronger sellers, value should have been down here. Didn't happen. Absolutely did not happen. What's going on with the NASDAQ? Value area is here. Here's Thursday's high, overlapping to up. Point of control is actually over the Thursday high on this one cleanly, definitively. Notice also the poor high. These look a little bit funky if we zoom in here. That actually does look like a true poor high. Yep, on F and G period. Sometimes as you scrunch these up, the way the TPOs are displayed is a little off. Anyways, poor high on Friday's session out of the NASDAQ, certainly worth carrying forward as well. Let's go on over to the Rusty Russell because this is where we do have some concerns in terms of headwinds for the broad market as a whole weekly time frame chart. Let's take a look at what's happening over here. The biggest concern is the fact that this breakout level has been unbroken, if you will. So failed breakout is what we would consider this box right here. And it's not like we had a big long lower wick here that tested into the range and then closed back above. If we did, that would be bullish. But the fact that the weekly is closed inside of this consolidation, ascending triangle, call it whatever you want, the fact that this is a failed breakout now is concerning for the S&P 500 in particular. If small caps are not going to participate in this rally, and we know that we had breadth issues coming into this large breakdown, I don't really know that this is going to be a huge help, right? And so once again, small caps headwind for the S&P 500 now. If you're enjoying the weekend video through all of this like impromptu analysis on the fly stuff, let me know in the comments section. If you're not, if you're like, dude, you should be way more organized, let me know in the comments as well, and we'll do better next time. But for now, we're running with it. What do we see? Same concept happening here. Let's go to a default chart. Obviously, that level is going to be at 227. Lower high risk there, in my opinion, is way more meaningful than what we have in the S&P or the NASDAQ. I think that the Russell had already been in a very decent downtrend happening over here. It was grinding to the downside, and this is the exact thing that I was just saying. Markets crash from the lows, right? I would say that the Russell crashed from the lows, versus the S&P and the NASDAQ, which basically, air quotes, pulled back from the highs, right? Note the difference here, and this is something that you should sear into your brain as an analyst, right? This was already in a downtrend. This was weak. It crashes from the lows. The other ones pull back from the highs. There's no opportunity here for a higher low to save the day. This is lower high all day long, breaks the weekly chart, breaks the daily charts. Everything remains to the downside, right? So this is still a headwind for the S&P 500 for those reasons. I know we don't really have too many Russell traders, so we'll just quickly look at the hourly levels, then we'll move along. The main premise is that if this remains weak underneath 227, it hurts the case for the S&P. If it rallies to recover that on some sort of miraculous Christmas gift over 227, hey, let's rejoice together. Pour a glass of eggnog on me, and we'll rally back to the upside all-time highs in the S&P. 227. Key levels, again, that's that. So to get there, you've got to breach 224.25. This here gets you there above it, and you can start to walk these things up. Again, lower odds of that considering everything that we've just described on the weekly with the breakdown and crashing from the lows. If we're just in this range, it's really just a bear flag. Bear flag, keep it simple. Underneath 218, lower edge of the weekly expected move 215.25 becomes a target, and 210 is your larger area as well. Makes sense on the daily. Zooming back out to this inflection point here. It might look funky, but the way that we stayed underneath and then rallied to recover that area is quite important. So those are your levels out of the IWM. Let's quickly take a look at the Russell internals, see what's going on here. Strong volume inflows, yes, but not quite the inverse or stronger than the inverse of what we had from Wednesday. So I think this continues to add into the narrative of what we're talking about with small caps, where the operating environment based on Jerome Powell's rug pull saying, hey, you're not going to get as many rate cuts as you thought, is really taking much more of a firm effect in the small caps. Makes sense. So the volume inflow is not as substantial. This did not really stay in trend higher zone. It made it there, but it didn't stay there. And then your cumulative build actually fell negative out of the Russell instead of the other two, which remained positive. Quick look at the Rusty Russell through the lens of market profile. What do we have here? Value was not overlapping to up. It was overlapping with the prior day, but it was definitely not overlapping to up. Point of control made some progress in the upward direction, but to me, this is much more of just an opportunity for a counter trend move in the Russell, not something that's going to define the next leg of some sort of reversal of the trend. This to me just looks like continuation of the downtrend, right? There's give and take. There's your lower high. 227, headwind, S&P 500, right? So that's the one bearish thing that we can add into the narrative here is that small caps will likely not participate or at least act as a kind helping force for for the S&P over here. Let's take a look through the sectors. In terms of weekly performance, no surprise that everything's blood red here. Leading the pack to the downside, though, is the energy sector, down over 5%, followed by real estate, materials, then it's communications, then it's discretionary, then it's semiconductors. The reason I'm sort of going through this exercise is just because we know energy is not a heavyweight risk-on sector. Real estate is not a heavyweight risk-on sector. Materials are not a heavyweight risk-on sector. Communications starts getting towards more risk-on, but it's not heavyweight. Discretionary is absolutely heavyweight and risk-on, but generally speaking, the top three, in terms of being beat up the worst, they're not risk-on sectors. So is it reasonable to assume that this move, again, on the weekly chart, weekly perspective, is a counter-trend move in the context of an uptrend? I think the answer is still absolutely yes, and the sector analysis here will support this thesis. Let's jump into these charts. Let's see what's going on. So not a shock. Energy, big move to the downside. Breaking down through this range is somewhat concerning. We've been talking about this theme, right? It's the global recession minus the U.S. U.S. just reported GDP numbers and no recession here, right? So energy drifting to the downside, not really, it doesn't seem like a concern to me for the S&P 500 at least. As we look at real estate, huge new pivot low, obviously sensitive to interest rates. Interest rates exploded. That to me is something to think about, right? Interest rates will continue to pressure the broad market in theory as they move in the upward direction. So that's not all that kind, and real estate is a reminder of that. But as we move along, materials, the lightest weight sector in the S&P, making a new big swing low. That, of course, is important. It's noteworthy. Is it going to sink the ship for the S&P? No, especially when these charts look like this. So make note of these right here. Communications. Any issues with the uptrend here? What's the overwhelming trend? Up. What did you notice about materials? Sideways. What did you notice about real estate? Sideways. What did you notice about energy? Sideways. What did you notice about communications? Uptrend, right? Higher low is the name of the game. Over the 50 SMA, not a cause for concern. Discretionary. Is this sideways or up? I mean, come on. This is a huge uptrend here out of discretionary. Where is my drawing set, please? Somebody? No? Maybe Thinkorswim's broken. Maybe I deleted it by accident. Anyways, it's in an uptrend. We're all set on this. As we take a look at semiconductors, oh no. I'm thinking Thinkorswim is maybe undergoing maintenance now, and we're going to lose our levels. This is not good. Not good. Anyways, semiconductors, not looking so hot towards the bottom end of the range. However, I have to give credit where credit is due. It's holding up in the range. If we were to break down underneath this level, right around in here, it's really disappointing that I actually don't have these levels on screen currently. There's got to be something going on. I think it's 237 that we've been using as the main number. 237. If we're over 237, we're okay. We are okay here on the SMH. Consolidation in the range looks okay, and hopefully you get some sort of continuation. That would certainly spark a Christmas rally. If you drop 237, that's where that's a red flag. So really making note of that. This is not in an uptrend. This is not helping the case for the S&P 500. This, to me, is one of the top charts to watch into the end of the year, because if this breaks, it's probably bringing the S&P with it. If this can at least go sideways, I think we have enough strength in discretionary, communications, and some others where we can continue to see that rebound back to highs. Here we go, XLI. What's going on here with these zooms? Maybe just some sort of funky, I don't know. Anyways, we've got our levels back, apparently. XLI is about 8% of the S&P 500. Not the end of the world, but certainly making note of the double top breakdown. Generally, a bit more neutral. I'd be more neutral on this chart. I think that there's an opportunity for a lower high happening here that we should respect. Here's the XLP sideways. This is D for defensive. It's also lightweight. I'm not as concerned. It is downward pressure as it makes a new swing low underneath 80. TLT. Just as a reminder, I have shorts, technically I have short puts, I'm long, TLT in terms of directional delta, at 85. So I think that TLT either makes it to 85 and I'm happy to own bonds at 85 and we look to farm the yield and then sell for a profit somewhere up here, or they just expire worthless and so be it, right? We get something that looks like this and then it cools off. I don't think that we should... Although Jerome Powell indicated that, hey, you're probably not getting as many cuts as you thought, I don't know that interest rates are going to continue to move in the upward direction aggressively any further than they did back in, if we just zoom out on this chart. I think we saw a high of about 5% on the TNX, which was over here. So TNX at 5% sort of brings bonds, TLT at least, towards 82.25. I think that that might be reasonable. There's a path to get to 5% on the 10-year, but beyond that, I don't really know. To me, it seems that there would be more of an opportunity that because we're still promised at least one rate cut in 2025, that there's an opportunity for rates to come down and sort of top out at that. If you were to apply like technical analysis to, let's just jump over here, in the spirit of having like a crazy show today, we're all over the place. Let's just take a look. Here's the TNX, and here's that, that's 4.7. There's 5. Let's go to a weekly so we can see that, right? So I think that you have a path to get here. We've been talking about over the last couple of weeks how this resistance trend line, it started to break here, then it looked like a failed breakout. Now it's looking successful. And with the catalyst of Jerome Powell giving the market his blessings basically to say, hey, you're not going to get so many cuts, I think the path to 5% is there. But beyond 5%, I'm not really seeing it. All right, we're still going to get some sort of cut out of rates. Or if we don't get any sort of cuts, then the labor market starts to deteriorate too much. What's going to happen? We get the emergency rate cut from the Fed. He tries to bail out the labor market. And what does that do to bonds? Right? Something like that. So I think damned if you do, damned if you don't in terms of the position. So that's my take on bonds and yield here. As we move back on over to these charts and continue through the sectors, XLF financials, this is a little bit of an issue to me. The fact that we found a sort of lower high rejection at the 50 SMA at the top of the gap here on the Friday rally. So just a counter trend move until proven otherwise. And this was more susceptible because it had already broken down from a head and shoulders, right? Left head, right. I would need to see two things here. If I'm going to be thinking about an S&P back at all-time highs, show me this in continuation, or just close the gap, get it over with, and then start forming a higher low back over 47.75 from over here, right? That would be the bullish continuation play out of the XLF, setting something like a weekly higher low, right? Weekly higher low happening there, right? Next up, XLV, heavyweight component of the S&P 500, absolutely an issue as it continues to just fall apart here in the downward direction. I don't think it's enough to overweigh or outweigh what we've been talking about in financial, setting that higher low, and then namely semiconductors as well as discretionary communications, and we'll see the tech sector in just a moment as well. So this is a concern. I mean, lower highs absolutely can persist here underneath 138.25. I think that this is an issue for the S&P. Thankfully, it's the most D for defensive heavyweight sector. It's not a heavyweight risk on sector, right? It's risk off technically here in healthcare. So making sense to me that this is in a downtrend where the S&P 500 is still technically holding up. If we had a downtrend over here in the technology sector, I would be much more concerned, but we don't. As we take a look at this chart, notice that we have this and we have this. This is the improper end of the auction. I think that if we can get over the previous all-time high, 238, it's a matter of time before seeing new highs. If we remain under 238, that's where I start to fall more into the consolidation phase and thinking, okay, weekly balance, daily balance until proven otherwise, and then we'll learn something about the market when it can get out of, whatever it might fall into, this range here, right? So that consolidation probably puts a damper on things into the end of the year. If you're looking for more of the bull case here, you really got to get back up and over 238, right? We skipped utilities in the sake of staying on the heavier weight sectors. Utilities, the most bond-like sector. It looks like my drawing set is gone here as well. Underneath this, making a new big pivot low. Not really a shocker considering that it is acting like bonds basically, as we were not promised as many rate cuts anymore. So any rallies here that then do this, set up a lower high, set up continuation to the downside. Thankfully, this is lightweight. It's also D for defensive, not going to have too much impact on the S&P. Let's quickly fly through some of the supporting evidence here. Sector ratios, looks good, looks good, looks okay, could be better over the 50 SMA. But considering all the selling that we've seen, you would have expected some of these ratios to be flashing like risk off, and that's not the case, right? This even looks good here because XLV is D for defensive. This is not trying to trend in the upward direction. This is getting a small curl in the upward direction, but it's still underneath a downward sloping 50 SMA. So do we have any issues from a risk on versus risk off perspective? No. As we take a look at some specialized ratios, look at these nice little labels that I've added. Nice little custom script there for each one of these. Looks risk on, looks risk on, looks risk on, looks risk on. Any issues? No. EEM, let's take a look at the yen carry trade just because of the Japanese data we got. Let's go USD JPY, and let's fire that up over here. So August 5th, when we were seeing pain from the market, that's this over here. Any issues? No. Right? A little bit of a downtick on the hotter than expected inflation read, but any issues in terms of the market exploding in the currency pair? No. Let's take a look at we know we can also substitute out the N225 JP, which is the Nikkei, of course, and a little bit of a rollover here, but our take has been, and this has been pretty consistent if you've been tuned into the pre-market preps, let's just quickly throw on a candlestick chart here. As long as we're in this range and we're not breaking down underneath, let's just say 38,000, we're pretty good here. There's not a big cause for concern. This is what, in my opinion, causes so much panic over in U.S. markets when the Nikkei is exploding, basically. This is just sideways in a range, right? So, yeah, they're dealing with some hot inflation, but anything outside of that? Not really. Not really. We'll see if it develops into something worse. If we're underneath this bottom end of the range, we'll change our tone, but that's not the case as of right now. Let's continue along. Where were we? We were on the dollar is up next, speaking of currency pairs. So dollar strengthening here, as well as like the yen strengthening too as well. So you're getting both currencies moving in the upward direction, but the dollar is currently, outpacing at a fast enough rate where the currency pair and the reflection of that value is not at a point where it's concerning, right? So dollar's breaking out. What I want to show you on this is the weekly chart. Huge breakout on the dollar from this big, long-standing 2-year balance range. This is literally a 2-year balance. So if it's going to make a move to the upside, right, that in theory continues to put some downward pressure on equities. But what did we see over here, right? Let's do this. Let's come on over here. 2022 was a time of pain, if you recall. What am I looking for? There we go. So as the dollar really rallied to the upside big time, that's where the market really said, hey, we're not going to, earnings should be compressing. Not good. Bear market, right? So it was the topping of the dollar that aligned with the October low. It was the monthly higher low thesis that we talked about over here, right? All of these things combined told us that, okay, in October, probably smoother sailing out of the S&P. If this is going to break out and continue, it doesn't really support the thesis that we've been talking about so far today. My sort of back pocket component that maybe neutralizes some of this bearishness would just be that if we do get interest rate cuts from Jerome Powell, this is going to fade off. It's going to look more like a failed breakout, in my opinion, over the span of 2025 as a whole, right? So watching for that. Obviously, as we get new administration, this can change also based on the whole promise of these big tariffs. The US dollar would materially strengthen in that case, which is going to put some pressure on US equities. We'll see how that plays out one step at a time, but just based on the technicals, has to be a little bit more of a bearish data point here on the dollar. I'll say it. I will say it. Let's take a look at the interest rates, which we already talked about on the TNX, breaking out over the equal high. Next step is this high from back over here. You could even come in from a daily perspective and say that we had a break of the resistance trend line happening here. Break, retest for a higher low. Now looking for continuation in the upward direction. So we've talked about the path to 5%. That's probably not kind for equities down below, but I think that the more compelling case in the short term is the oversold reaction back to the upside, even if it's just to set a lower high underneath the bottom of the balance, right? So I do think that upside move is more likely. I'll stand by my analysis. Let's move along to the gold contract. What's going on with gold? Is there any flight to safety happening here? No, not in the ratio itself. Not seeing an uptick, not over 0.4, not over the next level as well. Let's move along to, here we go, TLT ratio to the S&P. We'll talk about, no, we'll go over here. I know I'm all over the place today. This is probably one of the worstly organized videos I've put together in a long time. There's a lot to talk about, though, and my brain's going in a million different places as we're developing these data points, right? This is the current rate. So not forecasting a Fed rate cut for the January meeting. The next rate cut is being priced into the March meeting. That's something to carry forward. The other thing to carry forward here is that the SEP, which was just released on Wednesday, outlines 2 rate cuts to get to a Fed funds rate of, not a 4, a 3 handle here, a 3.9, right? That's what the Fed was sort of projecting in their SEP. This doesn't even get us there. Notice that the market's not pricing that in at all. The market's saying right now, right, based on what the futures are trading, no, only 1 rate cut. So think about it as if Jerome Powell does not break this promise, if he keeps, the promise of 3.9 on the SEP, and we'll get new updated SEPs probably in March. I don't think we get one in January. But in the new SEP, if 3.9 is maintained as the rate for 2025, you're probably going to price in another rate cut here. And what does that mean? Markets like that. So all this bearish activity has priced in the reduction of rate cuts. If we go back in the opposite direction to price in more rate cuts, that aligns more with the bullish thesis that we've been presenting so far today. Let's move along to the economic calendar. We know that we got, let's take a look over here. Let's go to previous week. Oh, we're at the top, the 15th. Let's scroll down. What I wanted to focus on was the PCE numbers that came out on Friday. Where are they? Friday, here we go. So actual 0.1, previous 0.3, consensus beat, right? As we take a look at the year over year and the core year over year, let's just look at these two right here versus the previous, and we also have the expectations here and here. The main point is that the PCE year over year came in at expectations, under expectations at the prior, and it stops the trend in the upward direction, right? If I do something like this and tap into this is an uptrend, this is an uptrend. We all know how Jerome Powell feels about one report does not make a trend, right? That's the whole theme of transitory was transitory, right? So this data is a good first step, but ideally we start to see this roll back over to the downside. If that takes place, we probably price in a much more bullish market under the pretenses that that second rate cut will be available as inflation subsides. So the fact that this did not increase to the expectation, which was a 2.9, in my opinion, is a good step. It's not a holy grail step, oh my goodness, this has to happen now, but it is a good first step in terms of continuing to monitor the data. That's your inflation read from last week, and you could take a look at Japan as well. Japan missing inflation targets, right? The forecast was for a 2.5, came in at a 2.9, way hotter than the expectation. So you'll continue to hear chirps about the yen carry trade and how that's going to influence markets. I'd keep an eye on it, but I really think that you need the confluence of the Nikkei exploding as well as the currency pair dramatically falling off of a cliff. Neither of those two things are actually taking place as of right now. As we look forward to next week, not a surprise that it's pretty quiet out there. There's not much going on in terms of economic data in the context of Christmas, of course, on December 25th, like it is every year, Matt. As we look at the actual calendar over here, I do want to point out that this is where we have the market holiday, but the 3 asterisks remind us that the market will close. Can I zoom in on this? Yes, I can. Markets will close at 1 p.m. the day prior, Tuesday, December 24th. Okay, so be mindful that things are probably going to start to dry up in terms of liquidity. Once again, lower liquidity, higher volatility. Where's the graphic? We've got it somewhere. If I do this, you can probably find it. Let's come on over to here. And let's jump into this, and let's take a look at this as I scroll down. It's somewhere in here. We posted it over during Thanksgiving. It'll be a little bit lower. Now I'm just wasting your time, which I feel pretty bad about. Maybe I'll edit this segment of the video out, but probably not. As I scroll down, where is it? Where is it? Where is it? It's in here. Bear with me. I know it's in here. I know it's in here somewhere. Oh boy, oh boy. There it is. Got it. This is the depth of market on the S&P 500 futures. As you have a lot of depth of market, that's a lot of liquidity. You have low volatility. Here we go. This is the VIX, right? This is the VIX down here. As you get low liquidity, you get high volatility. All right, so be mindful of this. Although everybody classically says, oh, it's going to be a short holiday week, it's going to be a really quiet market. Yes, the markets might not go anywhere. However, in the circumstances where we have low liquidity, don't be surprised if moves are more sporadic than you might think, okay? So that is that. I'm not saying that the VIX needs to spike up to a 35. I'm not saying that the VIX needs to spike up to a 30. But in general, lower liquidity means higher volatility. So what does that mean from your trading perspective? Stop losses should get wider to accommodate the chart. Targets will get wider to accommodate the chart. But what does that mean for your position sizing? You should probably reduce your position sizing if you're trying to keep the same number of dollars at risk as you would normally. All right, enough about that. Let's take a look at the earnings calendar. Obviously, there's nothing going on here for the next 2 weeks, and then we'll kick it back off. Really, the week of the 13th is when earnings come back around with JP Morgan, the one and only, to kick off the big season. So we'll watch out for that, but pretty quiet over the next little bit. Let's quickly look through our additional indications. TLT ratio to the S&P, no flight to safety here. Bonds are continuing to scream as interest rates move higher, really on the shorter end of the curve, which is kind of funky because the longer end of the curve is really what was driving the steepening of the yield curve over here. You know, as you look at this, we technically had an up week. I could drop this to a weekly. We had an up week as the longer end of the curve moved up. So thinking about that in relationship to the bonds chart over here is a little deceiving. I think that the move lower on Friday is going to kick off a stronger move to the downside as long as inflation continues to subside, or at least come in at expectations based on PCE. The next cycle, of course, will be CPI deeper into January. Let's take a look at the credit spreads. You can see that they're still elevated, but coming down aggressively into Friday. I would really look for these to roll back over underneath the 50 SMA. If that's the case, then we're in the clear. If they stay above the 50 SMA, I would sort of, keep an open mind to some of that bearish consolidation we were talking about either. Credit spreads are a direct reflection, basically, of volatility. Let's take a look at junk bonds in isolation. Huge bearish divergence, right? Look at this low versus this low versus this low. Big bearish divergence, so junk bonds still calling the bluff of the S&P 500, which is maybe reasonable, but for now, I don't think that we want to be trading this. I think we want to be trading the short term. Watch to see if this can hold a higher low. If it can and trade back to the equal high, it's game on to get back. Oops, sorry. Watch this to see if this can hold a higher low. This holds a higher low as well. Game on to get to here, even if this just rallies into like 79.50. From there, we would reevaluate, right? That would really set up the next opportunity for a potential lower high. I would play the divergence on the upside much more than the downside here, basically, is what I'm saying, out of junk bonds. Let's move along to Bitcoin. It's firing a sell signal based on the Saylor-Schiff ratio down below. Doesn't mean that it's going to go to zero, but I think a pullback could easily unfold if from a technical perspective we start breaking down more firmly. These are the Bitcoin futures. The level I would use over here is roughly around 92.3, right? 92,300. Moving along to breadth. The breadth continues to contract here. Notice that we see another downtick, not a shocker considering the breakdown we saw in the market, but considering the degree of the breakdown, this is really not as bad as I would have expected some of these readings to come in at. If we specifically look at the SPX A50R, this is getting into like buy side territory. This is oversold. This is like, oh my goodness, everything's crashing. Well, we're still in an uptrend. So if stocks are underneath their 50 SMA and we're going to rebound back above 50 SMAs to recapture this from what's severely oversold, right? Historically, you could take a look at this. We really don't spend too much time down here. We've just barely started. This is because of the move back higher on the weekly, right? So this is the weekly close versus the daily close that we were just looking at. So please understand, we've truly tested that at 0.2. Little oversold. If we rebound off of this, again, the counter trend, that starts to make more sense down below. Let's move along to the RSP, which is just blatantly underneath its support trend line here. So I think a counter trend move could set a lower high, and then we have more concerns in the future. This is more similar to the HYG, where I would play the lower high possible divergence versus what's going on off of these lows. Like I would not look at this and say like, okay, it's got to crash and continue further. That's not how the equal weight index really works at all. Let's move along to the QQQE. Similar story where I would play if there's a divergence like this where the equal weight cannot recapture and this is trading near all-time highs. That's where I would say, okay, maybe reevaluate, or at bare minimum, just don't be a new money long at the all-time high if this is divergent, but we're not there yet. It's got some room to go. And again, I think it supports more of the idea that we get there first. Let's take a look at the Dow Jones. No good, same thing, big failed breakout. I think this is more reflective of a similar story to what we've been talking about over in small caps. Moving along, we already talked about volatility in big detail. We'll quickly check in on the skew, pulling back a little bit, people unwinding some of their big black swan risk bets, basically, and in my opinion, that makes sense considering the end of week rally that we've seen. Let's jump on over to the core list of companies. If you've made it to this point in the video, my goodness, what are you doing still listening to this guy? I am just absolutely droning on this week, which is probably shouldn't even mention it, but in the video, right? It's like, why would you do that? But anyways, just being self-aware, trying to. NVIDIA, what do we see here? Balance range. It's very interesting, the bottom end of this range. It's not really giving way, the head and shoulders neckline, in the way that you would expect a large capitulation breakdown to start to unfold. I'm still a fan of the daily trend remaining down. We have lower highs, lower highs, lower highs. That's subject to change over 135. You start to come into the test of the daily 50 SMA. We just saw on the SMH, or we didn't see because the levels were not active. I don't know what's going on with Thinkorswim, but we just saw how the SMH is holding up in its range. If this breaks out, it probably sends the SMH to the top of the range, maybe even threatens a move to test the top and break out of the top. So watching NVIDIA very closely at 135, one of the things that, through this entire pattern, as we've been saying, like, hey, head and shoulders, right, everybody's looking at it. Through this entire pattern, one of the things that I've been a proponent for is like, if this fails, you better get out of the way on the short side. Like, you cannot overstay your welcome on the short side here if this starts to fail the neckline break, because in my opinion, anybody who's overly leveraged in here, this is going to squeeze to the upside, and NVIDIA is going to go on one of these tears again where it's the one stock to rule them all, and it pushes the markets to new all-time highs again. So that's one idea. 135 is the original gatekeeper for that. If we take a look at the hourly chart, right, you can start to see how the hourly is, you could call it a double bottom. You could call this the double bottom. You're already over the neckline with consolidation here. In my opinion, this really starts to move over 135, which is why I've been a proponent for that level. Right, so there you go. That's an early week trade. If we're just chopping around in here, I'm not interested. If we start to take out 129, I think the bearish breakdown continues. Keep it simple there on NVIDIA. Microsoft, daily time frame chart. What do we see over here? Not great. This top end of the balance range from here, rejecting in the upper wick from Friday, closing underneath. To me, as long as we're underneath 438, the bears have the upper hand, looking for a rollover to back test, or to come back into, I should say, for a retest of this equal low. If that's the case and we cannot get back over this level, no good. This has to turn into either a double bottom over time, 1, 2, then a higher low over 438, or consolidation here just sets up a bear flag, rotate back to the downside. So Microsoft failing the breakout here, in my opinion, is not a bullish sentiment for the S&P as a whole. Let's move along to Apple, see what's going on from this point of view. Equal high breakout, something along those lines, absolutely. Keep in mind the relative strength of Apple. The broad market breaks down from the all-time high, and where is Apple on Friday? Closing at a brand new all-time high. Let me pause here for a second so that can sink in. Where's the Elon Musk meme when you need it, right? Let that sink in. So anything that's over 253.75, it's just got to be continuation, right? I don't see really a reason to be an aggressive bear there. Consolidation here keeps it bullish as well, right? So Apple, bullish until proven otherwise. Any consolidation in here is exactly that. I would not want to be a bear. I would not want to be a bear in Apple. The only time to be bearish is underneath 244 for a retest of the weekly breakout. Let's not forget, right? This massive pattern over here, there it is. This would be a long opportunity as well. Moving along to Nancy. I think it's a pullback from the highest high. I think it's very interesting here at 215, the gap fill reversal and previous pivot high. I would like to see this and then continuation, or if it just gets in here, kind of, very choppy, excuse me, inside of that range. Very choppy in here, and then maybe something into blue sky territories over 230, 250, but very clear levels. I think for now, I still think this is a reasonable expectation. It was not really able to test and hold over 225.25 bottom of the balance, and also Thursday's high, the inside consolidation day. Next up, Google. What do we see out of the Goog? Finally breaking down from that head and shoulders I had been stalking for a little while, but gap down, rally. I think 191.75, previous pivot high from back here, has the offering of a lower high, but I think the short has mostly played. The short played on the FOMC breakdown. It played via the gap down on the Friday session. I don't know that being short dead on the lows makes sense now. I think that maybe this risk reward is playable. Here it is on the hourly, right, left, head, right. If you're going to continue to build out that right, maybe some more thin structure retracement through what happened on Friday's rally. But I would not be just blindly short here, right, on the lows of the move at 185.25. It would have to be like setting something up there on the 5-minute risk reward, right? That's the Google idea. Any consolidation up here, it really has patience. It requires patience to set up the next long. Next up, Metaverse. What's going on with Meta? Unfortunate that it could not hold up over the top end of the range here at 599. That was looking like a pretty good technical setup, but we all know even the best A+ setups can fail. So the lower high that's set underneath now via the upper wick from Friday looks bearish to me. I think that it's either a rally to set up another lower high. You could try risk reward that looks like this. I don't really see it as a long currently. I don't really see much of an opportunity either in the midpoint of this range, right? What do we know about ranges? Don't enter in the center, don't exchange in the range, don't diddle in the middle. Hourly time frame chart, sort of just the lower high. And then, to me, it's just continuing the hourly downtrend. We're failing back into that daily range at 599. Next up, Tesla. Consolidation, absolutely. As long as it's over 415, there's no reason to be a bear here. I would actually look for bullish opportunities back to the upside. I would love to see a sweep and higher low back above. That's a very tradable outcome in my opinion. Something that threatens a larger breakdown that fails, blows up in the face of those sellers. Right? It's the very same thing as what we just talked about over on NVIDIA. Moving along to JP Morgan, just like the XLF, sort of looking into that gap. This is actually a little bit better, holding up over the top of the gap at 234.75, the original top of the gap. Obviously, what remains is this segment down here. But if we go to the daily time frame chart, this could maybe find itself a higher low near the daily 50 SMA. This rotation keeps the S&P 500 pretty bullish, right? Financials, the second heaviest weight sector by market cap these days, right? So XLF, this is helpful. JP Morgan holding up at the bottom end of this range, which of course is the top of the gap. Moving along to Netflix, and then I've got two trade ideas for you. What do we see out of Netflix? More of the head and shoulders threat on the daily, right, with your right shoulder trying to build out. As we look at the hourly time frame chart, I don't think it's in play though, right? Why is that? Because if you look at this, you're holding up over 907.25. Consolidation here that rallies to the top end makes more sense in my opinion for risk reward. Along these lines, if it fails in here, I honestly just don't think that this is a very attractive range to trade. Could there be some opportunities? Yeah, but I don't see it as a clean way to execute the trade plan that I typically follow. So not in love with Netflix underneath 907.25. I think it balances off and doesn't really play nicely in this range. Two trade ideas. First one is on PLTR, the stock everybody loves. PLTR. What do we see? Taking a look at Palantir, we have ourselves this. Love to see it. Palantir has been incredibly bullish relative to the broad market. Again, think about Apple. It's almost on a level playing field with Apple. Not literally, but you get the idea. Here's the breakdown on Wednesday into the lows. Did not accelerate underneath. What happened on Friday? Right back up to all-time highs, basically. So holds of 76.60 look really good out of Palantir for a break up and over 80.60 into blue sky territories. If it chops underneath 76.60, it's just out of play. I don't think it's a short, but I also think it's very difficult to participate long inside of this balance. Last trade idea is Snowflake. Let it snow, let it snow, let it snow. Will it be a white Christmas? We will find out shortly, but Snowflake is looking bearish. So if we need continuation to the downside, we have Snowflake. If we need a move to the upside, we have Palantir. What's going on here? Left, head, right, under the neckline for consolidation, and a glaring gap underneath. 161.25, 133.75 to the downside on that gap close. Very interested in this possible breakdown if the broad market continues to extend the losses in the downward direction. If the broad market's rallying, I would just take Snowflake off my watch as a short. If the broad market's rallying, it's not a short. Not a short. You want the broad market to be a tailwind for you, regardless of what direction you're looking for, right? If the broad market's moving up, trade Palantir. If the broad market's moving down, avoid Palantir, trade Snowflake, right? That's how you use these two things. So 161.25 gap close, 133.75, as long as it's underneath this zone, which is the neckline at 188.50, 167.75. We are good to go for the bears remaining in control, looking for that continuation to the downside. That's all I've got for you in today's rambling episode of the weekend edition. If you enjoyed the breakdown of the S&P 500, if you enjoyed the comparison to the August 5th session and the detailed comparison we made, we looked at a number of different things, right? Which built the case for this being a little bit more likely, in my opinion. And I know I said my opinion a lot in this video as well. If you enjoyed that, let me know down below in the comments section or by giving the video a very simple thumbs up. You could always share this video with a friend, a trader friend of yours, or even a non-trader friend of yours, and that always helps as well. We'll be live on Monday morning up in the penthouse location number 1 for a remote show of the pre-market prep. We'll see how the market unfolds, and then we'll play it by ear as we move into holiday trading volume and whether or not it makes sense to do the morning show. So anyways, with that, I hope you have a Merry Christmas if you celebrate, a Happy Hanukkah if you celebrate that. Any other winter holidays that I'm missing, Festivus I think is one of them. Isn't that the Seinfeld joke? Any other holidays, happy holidays to whatever it is that you're going to do. Friends, family, hopefully have a good time with everybody. Eat some good food, spread some joy, do some good for your neighbor. That's really what counts, right? Have a good holiday, and if I don't talk to you between now and the new year, enjoy your time, and until then, have a green trading week, and I will see you in the next one.